How's it going? Last week, I tried to sell you on the idea that you are better off building a business that's a little bit bigger, that can produce an income for you, that does not require you bill all the work or you manage every element of the business or the majority of the business. The litmus test is, can you be gone from the business for some period of time? The video on the screen, Lawn Care Owners, What's Your Exit Strategy, was me trying to sell you on why that matters. If you did not watch that video, I'd recommend you do. So this is part two, and part two is, how do we go about building that kind of business? Again, the selling point in that other video, and you should watch it, was that in terms of building a retirement, in terms of building wealth, you will build it much faster by building this business, this investment, than you will be by doing what you're currently doing, running your business and saving the money from that business and taking that money and investing it elsewhere. Okay? So I will probably do a part three, but today, part two is, how do we go about building that kind of a business? One that has value to you. Again, one that'll produce income or a stream of income. So the way we're going to answer this today, and then I'll do a more tactical video next, but the way we're going to do this is, let's talk about some clues. And by clues, what I mean is, if you simply think about what are the things that someone that wanted to acquire your business would be looking for, what matters to them, if you answer those things, if you build those things into your business that make you highly attractive, you are building a great business. Now, what I was talking about and trying to sell on the last video was this idea of building something that you more than likely keep, that produces a stream of income for you for the long term, while it doesn't require all of your time and you're not the core linchpin in that business. What we're talking about here is very much around the idea of building your business so that you can sell it. And so if that's of interest to you, this video will be of value to you. But the other part of this is, these things that make you highly attractive are also what makes your business great and makes it a business that you would want to keep. So I made a list of words that came to mind for me when I think about someone that might want to buy a business, or if I was thinking about potentially buying a business in your market. I'm not. I'm just saying, if I was thinking that way, what would I be thinking about? What are others thinking about? So one thing that they're looking for is, they're looking for diversification. Potentially, they could be diversifying their own portfolio. So for example, I'll use a lawn care business example. Let's say they have a strong presence in a market in the United States, or a couple markets in the United States, maybe up north, and they're wanting a presence in the South. Maybe their portfolio of businesses is heavily weighted towards landscape, and they want a business or businesses producing a lot of fertilization, weed control work. There may be some element of diversification that they're looking for. They're generally valuing companies that have recurring, predictable revenue way greater than a company that does not. So if you look at the valuation on a maintenance business with contracts, and it recurs and it's predictable and it grows in a predictable way, as compared to a landscape or design build or construction-based company, the valuations are very different. They are buying a stream of revenue. If you think about how money works at a very high level, there is a massive pool of money available out in the world, and there are individuals whose sole purpose and job is to put that money to work and get a return on that money. They can put the money into equities, they can put it into real estate, they can put it into bonds, they can put it in all these different places. And one of the places that money likes to go is to businesses, and very strong businesses, because businesses can produce an out of the ordinary return on money. Okay. And so if a buyer can find a business that can produce great returns in terms of potentially spinning off cash through profit and appreciation of the asset, the growth of the asset. So they buy it at $3 million, and at some point in the future, they can very clearly and easily see a path to that being worth $10 million. That's an interesting asset. All the while, it might even spin off cash at a minimum to fund growth, but it might also spin off cash back to the individual or group that made the acquisition. Money is looking for a place to go to get a return. If they believe that the return on average in the stock market is only 7% and they want to beat the return, they have to look for more aggressive investments. And as a result, very, very significant capital goes to acquiring businesses for that reason. You might have heard the term private equity. That's what private equity is. You can look at that if you're curious. And they're a big acquirer of businesses, service businesses, and especially in the commercial space, I theorize the day will come when they're very active in the residential space as well. Okay, so recurring is, do you have a stream of predictable revenue? They value it at a very, very high level. Do you have expansion proof? By expansion, I mean, is your business growing? Can you point to how the value of a client is expanding? So Miss Smith signs up, or ABC or Acme Company signs up with you, and Miss Smith is worth $100 a month, or maybe Acme Company is worth $1,000 a month. Can you demonstrate across your portfolio, and maybe I'm using words that I shouldn't be using, across all of your accounts, can you prove and show in the data that on average a count comes into your world, Miss Smith at $100 a month, and she eventually becomes worth $110, $120, $130, $140 a month? That's called expansion. If you can prove within your client base great revenue expansion opportunity, meaning you're growing the value of your clients by selling them more services, increasing pricing, things of that sort, selling them more transactions, meaning they were going to buy 6 applications of fertilization weed control, now they're buying 8. That's expansion. If you can prove that, you to a large degree de-risk the acquisition. I'm not going to go into all the details, but it's a factor. So again, why are we talking about this? Well, they're clues. One clue is if you diversify your business, probably a healthier business. If you have a recurring element, with the smart money values recurring businesses over non-recurring businesses, probably a clue. If the smart money puts great value in the expansion of revenue, probably a clue. As your business gets bigger, it becomes more and more difficult to keep growing the number of new accounts at such a rate that your business can grow at a very fast pace. So one of the easier ways to keep pulling off fast growth is grow the number of accounts and expand the number of accounts. That's the idea. Do you have real profit? It's sort of back to they're buying a stream of revenue. Okay, so real profit is your business is spinning off money. It actually has positive cash flow, not just at the bottom of the P&L, but real money is being spun out of this business that can be used to reinvest in the deal, or reinvest in the company to grow it after they make an acquisition. Or after they acquire you, one, they could use that money to grow faster. Well, I'll just leave it at that. That's one of the examples. It can get even more complicated where if you're a larger company, they might even acquire you for your stream of revenue and use that revenue to grow other businesses while yours can just naturally grow on its own. But that can get even more complicated. Do you have a unique competitive advantage? Is there something about you in your market that's different than everyone else? Do you run a unique business model? Do you do things different than everyone else? And you've proven that those strategies and that business model is different than everyone else's. And they could take that business model, acquire your business, learn that business model, learn that method, and then apply it to their other locations that they start, or apply it to other businesses that they've acquired, and take your model and teach that to their other business units, and then improve the profitability or the speed of growth of those other units. Do you have a brand? In your little world, you don't need a national brand, you may not even need a regional brand, but in your little world, have you created a barrier to entry? Have you made it difficult for others to really come into your market and take serious market share because you are now the recognized brand in the little world that you serve? That's of great value. Most companies don't think about building it. When they think about brand, they think it has to be national. It can be small in your market. Can you own that market? Do you have steady and predictable growth? Oftentimes, this comes from recurring revenue. It also comes about from who are the clients that you're serving. What area, what markets are you serving? Is that area a growing market? What does the data say? What are the beliefs and the trends moving forward out into the future? Will your area be a growing area? Are there young people moving to that area? Do young people moving to that area use technology? Is there a population exodus out of your market or into your market? All kinds of projections about the future of your market, the total addressable market. You could call it the TAM. That would be a word. What is the total potential of your market in terms of the amount of work that could be sold to that market across a bucket of services? If your market is a growing market, meaning it's expanding, more people, more businesses are moving in that area, the TAM is increasing. A rising tide lifts all boats. If you're a leader in that market, your business will naturally grow for that reason alone. Even if you keep marketing and everything else the same, your business will simply grow because your market is growing. That can lead to some prediction in terms of what revenue might look like out in the future. All right? What about your team? Do you have a team with a high level of knowledge that when your company is purchased, that team could run additional profit centers, that team could run in additional markets, could build new divisions. Is that team capable of continuing to operate and run and build the business as it has been growing? If so, that makes you extremely, extremely interesting if you have a high level of knowledge within your team. Do you know your numbers? You have to be able to demonstrate you understand your numbers. What does it cost to acquire a client? How many clients are you losing? Why are you losing them? Where are they going? Expansion revenue is an example. All kinds of numbers regarding the business and understanding the profitability of the accounts, they matter. Great software systems can get you close. So in some cases, you might still need to be tracking numbers in other systems or in other ways, but there's so much technology these days, you can get very close on those numbers. Those numbers matter. Are you a market leader? Are you in a leadership position? It sort of goes back to the brand idea. Are you the most recognizable player in that market? Are you the one that the market tends to think of to solve a problem? Are you a market leader? Market leadership is important because if a company who's the acquirer has a position or ownership in lots of other markets and they want to break into your market, if you're in a leadership position and you've established somewhat of a little brand in your space and you've got the right team and all these other things going on, it's going to be very financially expensive for them to come into your market and overtake you and become the player or one of the top 3 players in the market. Therefore, it might very well be cheaper for them to just come in and acquire you at a very strong multiple, because over time and the volume of the number of years it would take for them to break into the market and buy your service company, to break into the market and outcompete your service company and do all the marketing and everything that comes with that, they're willing to just write a big check to buy speed and just to get to a leadership position very quickly. You see that all the time, and there's tons and tons of models of that in the commercial side of our world. Who do you hurt? So, who is it that is hurt by you getting better and better and better and stronger as an organization inside your market? Are you taking market share from someone? Is there somebody that eventually needs to be in your market that's a much bigger player and you are essentially blocking them and you will make their life difficult to enter your market? Those are things. Just think about who feels pain by your world getting better. Who feels pain by maybe your company selling to someone else and not to them? That can also drive up the valuations. So these are some things to be thinking about that will get you a very healthy or a healthier number when you go to sell your business. But again, that's not what I'm advocating for. I personally love and believe in these businesses so far out into the future. And while a lot of technology is coming and there will be a lot of disruption, I believe that those that are adopting technology, both in software systems, but also in the technology improvements that will be coming through from hardware and equipment and robotics and all the other stuff that, yes, it's a ways out there, but those that are on top of their game when it comes to those areas, they are going to win in the long term. And while there will be disruption, I'm highly excited about it. And so for that reason, I don't see a reason to be exiting these businesses unless you just get some crazy number. Otherwise, these are fantastic businesses to build a very healthy stream of income for you for the long term, as I discussed in that first video. And so again, these things that I just talked about that make you very desirable in the market from a sales standpoint are the exact same things that will make you a very, very healthy and very profitable company that will pay you a very nice stream of income. Now, I know I threw a lot of information at you. You might say, I do not want to play at that level. Well, that doesn't negate the idea of still building your business to a point where it makes you $100,000 a year, 150, 200, whatever your number is. And I know for some, even hearing 100, you can't imagine how's that even possible. It's so possible. And I know it's hard, and it is hard, and it takes a lot of work, and it takes some mindset growth to believe that that's possible for you. Maybe you grew up in a world where it just didn't seem possible. It is. And people all around you do it and you just don't realize it. And so part of it's a mindset shift and a belief that it's possible. And once you arrive at that place, it's amazing how the world opens up to you. So the reason I went down that road is I know I'm talking big here and I am advocating, and I just gave you clues to big things. Like these things take work to learn and build your company this way, but you could build and capitalize on 2 or 3 or 4 of these things, and you would be vastly ahead of your competition. You might only build $1 million business, but you build it in such a way that you make really nice income and you have people in the organization helping you run the business. That's a great business. So don't imagine by the words I've used and the explanation I've used that this has to be a $10 million, $20 million, or even a $5 million business. Please don't imagine it that way. But these are some clues about things to be thinking about regardless of your size. And if you're not capitalizing on these things, my very last point at the bottom is this. If they're not buying for these reasons, then the only thing that they're buying is the value of your accounts and the value of your assets. And the value of your accounts is not really that big. And the reason for that is if you are trying to sell me your business and you say, well, I have a client that's worth $1,000 a year. I want $1,000 for that client. There's no way in the world I'm going to pay you $1,000 for that account, because probably through marketing, I could go acquire my own account worth $1,000 a year for $100 to $200. So why would I spend $1,000 buying your account when I could spend $100 to $200 in marketing costs to acquire that account? And that's why your business is only worth so much, and it's worth in a value of the account that is assigned, that is roughly equivalent to acquisition costs through marketing. That's why. So if you want your company to be valued like a real business, the numbers that we all imagine we could get for a business, then you have to focus on these items here at the top, because that's a real business. And people want to buy a real business, and people pay a premium for great businesses that are ran like real businesses. I hope that helps. There will be a part 3, and I will get a bit more tactical. See you then.